Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the weekly update on As Good as Gold. Over the past week, gold prices have somehow been in a consolidation phase, but bulls are actually gaining strength. Cooling US PCE GDP as well as PMI data, Powell's relatively dovish remarks at the Sintra Forum, geopolitical safe haven demand, and strong physical demand from central banks have all provided solid support for gold. The market is now eagerly anticipating Friday's U.S. non-farm payrolls report. If the labor market shows any signs of weakness, it could greatly boost gold's upward momentum. So looking at the recent performance of gold against U.S. dollar on the daily chart, bulls are absolutely taking dominance right now. Last Wednesday, gold prices dropped nearly 1% and closed below $2,300. Just as concerns arose about retesting the $22.85 range low, bulls came in strong the next day, with prices closing up 1.3% and reclaiming the important $23.30 US dollar resistance level. Early this week, the battle between bulls and bears was quite intense, with price fluctuations remaining very narrow and buying momentum clearly suppressed by the 50-day moving average. However, gold prices surged $27 yesterday, now actively challenging $23.60. On the upside, the $2,400 US dollar mark remains the key level to breach before further upward movement can occur. Well, if the bears take control, the $23.30 and the $22.85 might attract some bottom fishing bias. So with gold bulls clearly in charge, I think there are three main reasons behind. From the data perspective, the highly anticipated U.S. core PCE in May showed cooling with a month-on-month increase of only 0.1%. Additionally, the Q1 GDP growth rate of U.S. was 1.4% annualized, the first time below 2% in 6 quarters, indicating the U.S. economy's continued normalization. While both the June ISM manufacturing and services PMI fell short of expectations and even entered contraction zone, with the services data particularly disappointing at 48.8, significantly below the expected 52.6. So the market has increasingly priced in a Fed rate cut in September. And actually, I've also heard some chatters on the street recently about recession of the US. All of these factors are boosting gold's appeal alongside a significant pullback in the dollar index. Well, regarding the Fed stance, Powell's remarks at the Sintra Forum were more dovish. He mentioned considerable progress on inflation and hinted at a Fed put. So this appears to further endorse entering an easing cycle in September, bolstering bullish sentiment in the gold market. While on the geopolitical front, speculations about Trump's chances of winning the U.S. presidential election after the first debate and the increased pressure on the Democrats to change their candidates have added uncertainty to the market. Today's UK election, Sunday's French parliamentary elections, and escalating Middle East conflicts have collectively heightened risk aversion, supporting gold. From a higher time frame, we found that central bank gold investment demand, led by the PBOC, accounted for 85% of mine supply in Q1 2024, significantly higher than the 70% average over the past 2 years. So I believe the expectations of U.S. interest rate normalization, the trend of de-dollarization, and probably China's need to boost housing market and their consumer confidence have the potential to continue supporting central bank gold purchases in the second half of this year, boosting gold's performance. So overall, gold remains in a consolidation phase with bulls gaining strength. In the context of slowing U.S. inflation, weakening U.S. Economics data, a dovish Fed, heightened geopolitical risk, and strong central bank gold purchases, any evidence of further labor market weakness could pave the way for a Fed rate cut in September, further driving gold prices higher. This also makes tomorrow's June U.S. non-farm payrolls report highly anticipated. Now the market expects 190,000 new jobs added, a significant slowdown compared to the previous value, and the unemployment rate is expected to remain steady at 4%. Well, given Powell's remarks about how unexpected weakness in the labor market could trigger Fed action, I believe a deteriorated headline data, say 140,000, along with unemployment rate at 4.1% or even higher, could fully price in a rate cut in September, allowing gold bulls to expand their advantage and push prices back to $2,400 mark. Well, if that is the case, gold would more of an investment in my perspective. So that's pretty much for this week. If you have any thoughts on non-farm payrolls tomorrow or recent gold trading, feel free to leave a comment below as always, and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!